London-listed Capital Drilling, which provides drill services to mining companies predominantly in West Africa, has recently reported what it described as a significant increase in both profitability and cash at the full year. Joining us now is Jamie Boyton, Chairman of Capital Drilling. Jamie, it's good to talk to you. And in fact, you look through these profit and loss accounts, they're pretty impressive. You are essentially a small cap company. You listed on the primary listing here in London and you pay a dividend. Let's talk a little bit about where you get all these this money from, because my understanding is you're predominantly in the gold mining business.
We are predominantly gold. We've been working in Africa since 2004. We have a number of long-term contracts across Egypt and Tanzania, and more recently we've been growing the business into West Africa, where we're now in Mauritania, Mali, Ivory Coast, and we're moving into Burkina Faso shortly. 90% of the revenue does come out of the gold market for us, and a lot of our business is actually long-term mine site-based contracts doing grade control and blast hole as well as underground services. We'd also have an exploration business, which is how we're growing into West Africa at the moment. Yeah,
a dividend strategy is an interesting one. You produce a lot of cash. Your dividend at the moment is, I believe, yielding about 3%. What is the strategy around this, and what are you doing with the rest of the cash?
We had a really strong year for cash, and we finished the year with over $10 million net cash on the balance sheet. As a result of that, we increased our final dividend by 25%. Look, the payout ratio for the company is between 25 and 75% of post-capex cash flow. The current payout's running at around about the 35% mark, so there is certainly scope to look at increasing the dividend in the year ahead. But we certainly like to keep some cash on the balance sheet for opportunities that may present themselves.
Yeah, what about share buybacks and other methods of getting cash back to shareholders? Is that something you've got on your horizon, or is that really not included in your strategy?
Look, all the options are obviously discussed at the board level. With the preferred method for returns to shareholders at the moment are returns from the actual business itself as well as dividends. We do have a slightly less liquid than we would like shares on the market. We're quite tightly held by a number of the founders who still own over 50% of the stock. So our preferred method is to actually have dividends as opposed to buybacks.
Yeah, let's take a look at the share price actually, because I think it's interesting given the context of what's been happening. And we've got this uplift on the far right-hand side here, and I think that actually coincides with the release of these most recent earnings, doesn't it? What are investors buying into? How do you sell this to the retail investors? You say you've got quite a high concentration within the board at the moment. Are you wanting more retail investors?
We certainly would like more retail investors. Look, we've got a really high quality register outside of the founders. We've got some very high quality institutions on the register, but we'd certainly like to see more retail engagement, and that's obviously the attraction of the dividend we hope will help there. But certainly the share price performance recently leading into the results and with the results was very pleasing, and I think it's because we had marginally lower year-on-year revenue. However, we had a significant increase in both EBITDA and profitability and cash generation, and that really attracted some retail interest in the stock.
Yeah, I want to talk a little bit more about where the rigs are distributed, because I think 30% of rigs are now in West Africa, my understanding is. How many of these are actually employed at the moment?
Of the ones that are in West Africa, they're around about 50% utilised at the moment. Look, we've traditionally had the business positioned in East Africa, but when you look across the exploration spend in the African continent, Tanzania and Egypt, which are the traditional markets for capital, represent about 5% of the spend. The West African region represents about 45% of the spend, so it was just a natural growth strategy for us to get rigs over to the active part of the continent. So at the moment they're about 50% utilised. We do intend to send some more rigs across in the first half of this year, and we would expect to see contract wins and an increase in utilisation over 2019.
What's the process like at the moment for tendering for new businesses? Are you on top of things? Is it difficult? I mean, there's a lot of different countries with dictators in some places. I know that operate around some of the African nations. How difficult is it getting new business?
I think West Africa in particular is a slightly different market than the one we've been active in the past. It's characterised by a lot more activity but more competition as well. The tendering market's very active, but it tends to be shorter duration contracts, so for us it was really just function of having rigs on the ground because you need to be able to react quickly. And since being there, the tendering market for us has increased materially. We've also made some hires in business development, including one hire as at the 1st of March. So we've now beefed up the business development team, so we're getting a lot more tendering opportunities.
Yeah. What about the consolidation within the sector? I mean, we've seen Barrick and Randgold recently come together. What sort of difference does that make to you? I mean, they're still effectively, I suppose, drilling the same number of holes, so presumably, does it make a difference?
Look, it does. The last time we saw sector consolidation was back in 2012, and the first step is the consolidation. The second step is that once the assets have been acquired, you tend to see the mining companies increase exploration activity because they want to obviously prove up the assets that they've bought and develop the assets they've bought. So whilst it's still early in this cycle, I would expect to see it will lead to increase in drilling activity, and certainly it will start to. It's encouraging investors to look at the sector again, which is good news.
Yeah. How about consolidation within your sector? I mean, you talk a little bit about the cash that's on the balance sheet, what are you going to be doing with it and so forth, and how you view the market from your position. Are you having to look over your shoulder because companies might be interested in your business?
There's certainly a lot of opportunistic discussion that goes on with the drilling contractors about consolidation opportunities, but to be frank, there hasn't been an enormous amount of activity. There has been some small-scale acquisitions over the last few years, so it's not something that's front of mind for us. Acquisitions for capital drilling ourselves would be more looking at ancillary services as opposed to actually looking at other drilling companies.
We're talking about ancillary services. How is the lab sample testing business doing, which I know you've got in your books at the moment?
It's starting to improve. It certainly didn't perform as well as we would have liked in 2018, but we saw an improvement in the final months of 2018 and in 2019. And it's certainly it's a logical adjunct to our business for both exploration and mine site services. So it's certainly a good fit for us, and it's starting to show signs of improvement as we move into the current year.
Yeah, in the current year, do you ever have to consider the possibility that these large mining companies that are consolidating into these bigger behemoths, are they wanting to bring their drill services in-house? Is this going to be an impact for you, do you think, in the longer term?
For exploration drilling, it's an outsourced market. About 95% of it's outsourced, so we don't see any change in that level of activity. For the blast hole and grade control services, which is actually about 2/3 of capital drilling's revenue, that is about 50-50 in-house and outsourced, and we're not really seeing any major change in clients' behaviours in terms of how they treat that.
Yeah. Okay, let me just quickly round it all off and come back to where we started and take a look, not just at these earnings, but in the context of where you're going and how you see this year developing. What do you see as the big milestones that you've got? What's your pipeline like, that sort of thing?
Well, the big milestones for us, we started the move into West Africa more aggressively in 2018, and really I'd just like to see that completed over the course of 2019. So we finished last year with 31 rigs in the region. I'd like to see us move that up to about 40 rigs in the region. I'd like to see greater depth in the business in West Africa. So they're the main sort of goals we're looking for, and obviously commensurate with that, an increase in revenues and an increase in profitability again. And we would be very hopeful we can again look to increase dividends in the current year.
Yeah, well look, good luck with everything. Interested to see you next year. Come back to us, won't you? And talk about the business as it is, as it moves forward. That is Jamie Boyton, Chairman of Capital Drilling.